Hello viewers and welcome to my channel. My name is Emil Osterhima, an author, a consultant in the microfinance industry, a creator. I'm here to talk to you today about the case study of successful microfinance startup and process tips for profitability. A lot of us have been running a microfinance institution, have been having problem running it profitably. So today we'll be looking at some topics, some subtopics, and some key issues that will make us scale perfectly well. We're going to be looking at the table of content. We're going to be looking at the overview. We're looking at the break-even strategy. We're going to be looking at the product introduction and refinement. We're going to be looking at the branch expansion plan, which is key to you scaling. We're going to be looking at the profitability timelines. That's when it's likely you'll be making we'll be generating revenue with what kind of products, and we'll be looking at the vision for scaling, typically within 6 months, what difference you can make within 6 months of you starting of your MAB or your MFI. Then we're going to be concluding with that. So first, let's dive straight to the overview. When we talk about overview, what are we talking about? We are looking at one, your plan to upgrade your microfinance bank or microfinance operations. Either you are starting from the beginning or you have been running it, but it's not just satisfactory. The other thing we'll be looking at strategizing process for you to achieve an expansive portfolio. Now, the growth of a microfinance bank is not the same thing with the growth of the portfolio. If your portfolio is growing, your microfinance bank is growing. But if your microfinance is growing and your portfolio is not growing, then you are actually running a reverse microfinance. If I say your portfolio is growing, which means your portfolio that is generating revenue is growing. But if you keep opening branch and everybody is saying that you are having branch and you are not making profit, it means your branch expansion strategy is outgrowing your portfolio and revenue expansion strategy. So you should know which is growing. Another thing you should be looking at is forecasting profitability. How do you forecast profitability? What are the timelines? You need to understand that this is when you need to increase expenses, you need to increase salary, you need to just increase welfare packages, you need to increase your welfare social packages for your customer. You need to understand. It's not, you don't just wake up one day and decide to dish or dole out funds. It doesn't work like that in the microfinance industry. We're going to be looking at the break-even strategy, but then let's take this objective. Why do you need an objective in everything we do? You need to understand how you need to drive your expansion, how you need to drive your product, how you need to maximize revenue, how you need to generate and maintain a healthy portfolio. Your portfolio is your greatest asset. Your loan is your greatest asset. So if you don't manage them well, it is going to be reverse. Every capital that's eroded spells dooms for you. The regulatory authority won't take it lightly. They will likely shut down your microfinance bank if you are not performing well. Now, we're going to be looking at the strategy deployment. And the first, we're going to be looking at the operational infrastructure. Don't outfit your business. Don't over-equip your branch. Another thing we're going to be looking at is technology investment. For a start, if the funds are not there, don't automatically jump into the bank one or trying to run a digital lending infrastructure. Even currently, you might even not need to run with a core banking application. I've seen MFIs I've consulted for that are using just Excel and they are doing fine. The Excel is automated. Every day, if a customer is in arrears, it keeps updating. We're talking about market penetration and expansion drive. Now, what is market penetration? You cannot penetrate a market until you understand what the customers need. We basically produce goods and services that we want. But if you do a proper pilot and market testing, you understand what the market wants. There are basically some markets you won't want to enter as a microfinance bank because some MFBs or MFI, as they've already been there, they tested the water and they've seen how bad it is. At times, it's because of product mismatch. You are giving them the product they don't want, and you want to penetrate the market. Some of them just feel you are whipping from them too much, you are not giving anything. That's where social responsibility comes in of the market. Still on break-even strategy, we are talking about the revenue model and drivers. Three things drive your revenue model: your lending portfolio, which is what generates money for you; your banking services, which is another thing; then your agency and digital banking, partnership and infrastructure. But first, let's talk about the portfolio, the lending portfolio. What is your portfolio? Your portfolio is your biggest and your greatest asset. Now, your portfolio goes out within 6 months. What happens? It's supposed to generate revenue. If it doesn't generate revenue, which means it has defeated the essence for which the loan is being granted. That's why you need to be careful of the willful defaulters and unwillful defaulters. Microfinance have scaled beyond the 5 C's. Now let me talk about agency and digital banking. Run partnerships. Partner with POS operators. They are the key. They are closest to retail lenders. They are closest to the active pool. Strategy to adopt. We're going to be looking at 4. The first one is a customer acquisition plan. Now, what do you want to do with the customer acquisition plan? Which means you need to know how to target old customers that you have that left for one or two reasons that's best known to you, your staff, and themselves. You need to understand the tactics you're going to be using. Is it guerrilla tactics? You get another strategy you can look for is influencer partnership, market leaders. These are people that can actually touch you, but just put all this. You can add more. Just put all this under your customer acquisition plan. Then another thing you should be looking at is the revenue projection plan. Where you generate your interest from? Number 1, from the loan you disburse. 2, from your fees. Another third one, like I mentioned, you can generate from partnerships. Partnerships models that work well, that will just make sure they add additional income to your institution. Then we're going to be looking at monitoring and governance. One of the things that have killed microfinance till date is governance practice. There's no governance structure. Everybody wants to do anything they like, the way they like, or the way they best seems fit. These are killers to microfinance bank. One of the biggest problem of microfinance is staff turnover. If staff leaves and the customer believes that the money is all gone because the staff that gave them the loan is gone. It doesn't work that way. You have to look for a structure that keeps the staff, create structures, put operational procedures in place, get sanction grids that will make everybody to be in line with the organization policy. Once the structure and governance is monitored, believe me, you are going to have a healthy working place. Another thing we're going to be talking about, which is the first one, is the operational cost structure. You don't run a microfinance bank as if you are running a commercial bank or any other business. It doesn't work that way. It will run you aground. Now let's look at this 2 break-even pointer. You have to increase your loan portfolio within 6 months to achieve operational growth. That is when you start that is when you start understanding the kind of products that you are running. If you are introducing like 5 customers, 5 products to your customer, you should understand which one is producing well, which one is giving you high return, which one is giving you problems. So what you should do in this case is to try and know which one you are going to cut off, which one you are going to withdraw if you have concentrated on a portfolio risk, and which one you are going to make retail and expansive portfolio where you run an individual credit risk that's much more okay for you. At times, group loans, in some cases, might work out for some people. It might work out for you. It worked out in the Grameen approach, but will work out in other countries? I bet you not. Now we're going to be looking at the target break-even analysis, which means at the time you break even, there is every possibility of you to break down. Oh yes, I was in the industry 17, 18 years, and I can tell you there are sometimes where branches will make a profit. The next 2, 3 months they are making losses because the power of the branch increased. We get so comfortable at times, we feel it's going to work out, everything is all right, only for you to see that reverse is the case. It doesn't work like that, most especially in the microfinance field. Let's look at product introduction and refinement, and this is key. This is your generator. No generator works in isolation. It's either you push the button for it to work, or you draw the lever, the rope, for it to accelerate and start working. That is what products are. You don't create a product and keep them in your coffers or in your cupboard for them to work. They don't work that way. Now, for you to understand how this product works, you need to understand two models of product and 5 products that are under each of this model. Now, for every product, categorize them under this bucket. We have the micro savings product, we have the microcredit product, we have the micro-leasing product, we have the micro-insurance product, and we have the micro-transfer product. Now, this can be divided into the brick and mortar and the digital lending. What's going between the brick and mortar? You have the microfinance running where everybody comes in, they transact with you, they make their payment, they make their withdrawal. We also have the digital lending structure where you can access loans digitally even without you moving a muscle. You make your repayment and everything goes easy and smoothly for you. Now, both of these have their merit and demerits. We have some that are just running one model, which of the brick and mortar. We have others that are running currently that are running just the digital structure, and we have others that are running both models. And like I said, 5 basic products. You can run it on the brick and mortar basis, and you can run it on the digital lending space. Now, for the micro savings, this is a situation whereby you have access to funds from the general public. Now, note this: if you are running a microfinance bank in Nigeria, it's okay. You can run the 5 model. But if you are operating an MFI, you only have access to microcredit, micro-leasing, micro-transfer, and micro-insurance. Micro-savings is not part of it because of regulatory policies behind management of these institutions. Okay? Now, we talked about micro-savings. We know what it's all about. Poor people always want to save. They don't always need loan. But because they don't have access and flexibility to save, that's why it's like they don't have enough savings to meet up with their business adventures and they end up for loans. Now, microcredit is granting loans. Another thing we're going to be looking at is the micro-leasing. Majority of the active poor don't want your cash. They don't want you to even give them loan. They just need asset. They need tools. They need resources to run their businesses. So you can actually get them these tools, these assets where they will pay. Their payment retenue is usually longer than the normal repayment period. But between that period, it gives them the flexibility to use this product and pay with convenience, and it's one sure way for a microfinance to manage portfolio risk, because this time around the money goes straight to what you want to use it for. Now let's talk of the microfinance. Microfinance are not allowed to run microfinance product. But they can partner with insurance companies where they roll out insurance products that they pass across to micro insurance companies. With this, they have access to their commission and the rate, which is a very good sure product to maximize profit. Now, micro transfers. Micro transfers can be done where you partner with POS operators, commercial bank that acts as your corresponding bank to conduct transfers on behalf of your customers. These are a sure way to make sure that customers have their money transferred to and fro wherever they want. And it's a very good way to maximize business. Now you can, like I said, you can run this business as a brick and mortar, your microfinance, you can run it as a digital strategy, and you can run it as both. The only thing you are doing as a digital lender is that you are adding the micro digital strategy to it, which makes it flexible and you have a wider reach. Branch expansion. Your branch can be growing, but your portfolio might just be stagnant. Equally, your portfolio might be growing and your branch is not growing. Now, it depends on what you want. If your portfolio is growing, you are maintaining a one branch that the portfolio is increasing, but you are not opening branches, which logically is okay for a lot of people because the revenue is increasing. Now you can have 5 branches and they are not all performing, which means at every point in time, just because you have access to funds or you have access to capital or you have access to donations and you feel you can open more branches, thereby increasing your portfolio, it is wrong. That notion is not going to take you anywhere. So focus more on expansion, portfolio expansion over branch expansion. It is key. It will help you. Branch expansion should take would take in more resources, but portfolio expanded will take in more capital, and this is what the organization need. Okay, let's assume you want to deploy a branch. You need to even pilot test. Don't just send a branch down in oversaturated market. It won't help you. And even if the market is not saturated, make sure it is what the market wants that you are delivering. Key elements for rollout: have a uniform branding experience across location. Don't have one product here, another product. Make sure it aligns with what you have already analyzed during your pilot testing to work. And you need to understand your performance benchmarking, the targets given on a monthly basis, on a weekly basis. You just have to learn how to work all these things out to make sure that your microfinance is not underperforming where it's supposed to be overperforming. We look at profitability timelines. In the profitability timelines, we'll be looking at the scale advantage, revenue potential, cost efficiency, timeline to profitability, and the key profit drivers. Now, to scale advantage, you need to understand the ability to diversify your revenue across target niche. If you have 5 products, try and understand which one is giving you the best revenue. Do you want to do away with the rest? No problem. But just make sure that you maximize, you put in more energy, you put in more resources in the one that is generating more revenue for you. Now, in the revenue potential, on a monthly basis, study which microfinance can get you, which product rather can get you the best product. I have I have a template I can give out that will help you to monitor your performance on a monthly basis by portfolio, by sex, by product, by relationship officer, by industry, by sector. I'll drop in the description link. Just drop a comment and I'll drop it for you in the description link. Then we have the cost efficiency, economies of scale in operation. Are you using technology? Is it customer service that you are using to win their heart? Are you using any other third-party integrators? Are you partnership with? Just do a lot. Do what's going to be cost efficiency for you so that you don't burn money. Timeline for profitability. Yes, some microfinance is going to make it in 1 year, some will make it in 3 years. Understand how it worked for a branch for you before talking about moving to another branch. Now, apart from branch, even as a digital lender, you should understand circles. You should understand understand the demographic of where your customers are coming from and understand where those challenges are coming from when they eventually arise. Key profit drivers. Is it SME interest income? Is it FABIS transaction growth? Is it digital banking need? Just know where your key profit drivers are from. Focus on them. If you need to pay them visit, if you need to send them messages, but just focus on your key drivers. Now we have vision for scaling. We said 6 months. 6 months basically for a microfinance starting. Within 6 months, you should know if you are going to succeed earlier enough to start making good revenue. Because within 6 months, by then you have identified where your problems are coming from, where your problems are going, what is causing your problem. Is it man-made? Is it artificial? Is it from external forces, from internal forces? If it's external, is it economic? Is it social? Is it technological? Is it environmental? You just identify where your problems are coming from. Then capital deployment. Don't just start spending money just because you want to set up a microfinance bank or microfinance station or digital lending platform. You have to understand that the funds that you're going to be spending are for a purpose. Regional, technical, strategically, you just have to plan it all out well. Strategic enablers. These are the leadership, the financial inclusion, the human capital, and the governance structure. Every leadership structure counts. When you still in an organization, the people under you are bound to steal. When you come late, the people under you are bound to come late. Everything you do, somebody's watching. So it's bound to be replicated. Understand that financial inclusion is the key to microfinancing. Rich rural asset. Everybody wants to run a microfinance bank in the city. Yes, I can understand why. But then you have majority of your customers still in the rural areas that's going to make you those tons of profit that you're seeking. Human capital. Yes, this is very, very key. One of the dangers in microfinance is staff turnover after bad portfolio. A staff leaves, then the customer assumes that the money is that of the staff. This is one of the things that is killing microfinance. Putting structures in place, organizational procedures that will make staff always want to be with you, and make sure that they are well taken care of, well remunerated, well incentivized. This will actually keep them on the job, which will keep you from the recruitment cost that you are bound to encounter. The governance structure, I have talked about governance structure before. Make things work right in the organization. Then finally, we have the conclusion. I read, starting with a focused strategy, your microfinance institution through disciplined capital usage, aggressive customer acquisition, and target transaction can yield positive results within the shortest time frame. This foundation positions the firm strongly for statewide dominance and scalable growth at the end of the accounting season. You have to do the right things right. Nobody does a thing in the wrong way. You can't do something wrong and be expecting a different result. You always get the same result. So keep doing your best. Put policies in place that works with what needs to be achieved, and your MLB will be scaling successfully. My name is Henry Onyema, an author, consultant. These are part of the books I've written. The Functional Microfinance Bank is a bookshop nationwide. It will also help you to understand how microfinance work. I have also written this book called Basic Financial Analysis, Ratios, and Portfolio Monitoring in Microfinance Banks. A lot of people don't know how monitoring works. They don't know how performance works. They don't understand the ratio metrics. This book will help you to get these things right. I've also written a book titled Financial Inclusion, Microfinancing, and Digitalization. Though it will help those that are operating in digital lending space. Another of my book is titled The Nigerian Lending Business Manual for those that want to understand the lending scape in Nigeria. It's microfinance bank, microfinance institution, cooperative bank, digital lending, just name it. You will learn everything, microfinance bank, everything. You will learn how to manage your microfinance. Again, in our next lecture, please remember to subscribe to our channel, YouTube at Microfinance Arena. It will help you. We have a lot of contents that are engaging that will help you to grow as a microfinance professional.